Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. I am Daniel Dusina, Chief Investment Officer.
I'm Matt Mondoux, Senior Financial Advisor.
And I'm Dan Seder, Managing Partner.
So, couple of quick items for you guys today. First topic we'd like to cover is a brief discussion on U.S. China trade tensions, what that did to the market last week. By the way, we're recording today, October 13th. It's a Monday, so if we ever reference last week or yesterday, that's what we're referring to. Second, we want to talk about more broadly just potential valuation outlook. Should we be concerned after a sizable market rally this year? How does recent market activity kind of tie into that outlook? And then third, we want to talk about gold a little bit. Gold and other precious metals, those have been assets that have surged over the last, I would call it really year and a half. I think it's worth a discussion there. And then finally, we'll talk a little bit about some items going on in the mergers and acquisition space, which realistically could be even more pertinent as we get a more friendly interest rate environment. That sound good, guys? Or anything else we want to cover?
Let's do it.
Yeah, we'll avoid the Lions and the Tigers.
Yep, Detroit sports are not going to be mentioned on this
Michigan State across the board.
Nothing.
Yeah.
Okay, so let's jump into it. U.S. China trade tensions. Just when I thought I was out, they pull me back in, right? It's just like The Godfather with Donald Trump flaring up the trade war once more at the end of last week. So I think this realistically should have been at the top of investors' minds. But I think some of the hype around the artificial intelligence trade and general progress that was seemingly made on foreign policy relations led investors to be optimistic for the better part of the last 6 months. But over the past week, Trump floated potential 100% tariffs on China in response to alleged Chinese export restrictions on rare earth metals. And that's ultimately what rattled markets last Friday, October 10th. And sent the S&P 500 from, I think, trading up close to 40 basis points to down about 2.5% on the day. So markets have since recovered a little bit of ground after he softened his tone, I guess fueling some hopes that the full-blown escalation might be avoided. But still, you have a lot of folks out there that are cautioning around, this variable that has been reintroduced to markets, which I do think is worth paying attention to.
Yeah, and I feel like China's the main culprit here. I mean, we have to figure out a way to ease tensions between the countries, and I think they're going to give ever just enough to keep us at bay, but there's still a lot at stake. And I think if the U.S. were to get too aggressive and absolutely tank China's economy, that could have just a monumental impact on global financial markets, to the tune of kind of a Great Recession-ish type market response. And so I don't think Trump wants that on his watch. I think there's a lot at stake in that the negotiating is extraordinarily important. I think he's one of the best in the business at that. And so if he can figure this out, and I think they will, this will come and go. But it's certainly it's not insignificant.
Well, if you look back to April, we did find what Trump's pain points are, where are his breaking points. So what he doesn't want is a blemish of any kind on his track record, right?
Yeah.
So that would include negative stock market performance.
Sure.
By the way, the government really can't afford to have a period of elevated interest rates. So you're going to see him take cues, whether he tells this or not, from the stock market and from the bond market. So now...
Well, he came out and posted over the weekend, everything with China will be fine. And so he's seeing the reaction that happened on Friday after his post. He comes out and makes a secondary post over the weekend to say everything's okay. And it's so fascinating how they position some of the language where, he came out and said the highly respected Xi Jinping, and the way they have to address each other publicly in such a passively aggressive manner is fascinating, but he's going to figure it out.
Yeah.
He's going to figure it out. So I think China's still a huge threat, but I do think that this will come, and I think it'll eventually go.
In either way, whatever you think about what's going to happen, it was noticeable to me, or notable to me, that the markets, how they reacted, right? I mean, I think the market reaction was pretty interesting. I mean, the markets are looking for a reason to take some profits and pull back. We've had a pretty smooth run, I would say, all things considered, since April bottom. And that to me really felt like the market wanting any excuse to take profits, particularly in the 10 largest names.
Yeah, and that's why I think you have to be careful when you say generally the market. I mean, think of a market of stocks instead of the stock market. When you look at a market of stocks, defensive names were up, right? So it's the stocks that have run the most that are the frothiest. And sure, if there's a lot of uncertainty, yeah, of course, those are the ones, the further up they go, the further down they'll come. And I think that's natural. You're not going to see the solid, stable, consistent performers get absolutely hammered. You're going to see the ones that have been up 50% year to date.
Right. And that's notable too, because, Microsoft isn't, probably doing, as meaningful amount of business as some other, like soybean exporters. I mean, so some of these companies aren't as necessarily tied to China, don't live and die by China like some other businesses might. And same thing with China, exporting consumer goods here.
Well, that's like the perfect segue, I guess, elongated segue to what I've lined out as the second topic, is just general valuation concerns after a period of pretty significant run in the markets. I think the most common question that is asked these days, by and large, is why would I invest now? Are we near a market top? Aren't valuations above average? And I think, to your point, Dan, the answer is, well, it depends on what you mean by the market, or it depends on what you're looking at. Have those AI-related names run meaningfully, and are they expensive relative to their own histories? Yeah, absolutely. But at the same time, that's only because the earnings outlook over the next 5 years for those same companies is dramatically more rosy than it was over the prior 5. So I think that we're at this point now where, like Matt said, markets are more or less looking for an excuse to take a quick pullback.
Yeah, it's seasonally weak period of the year as well.
And so when what you find is that markets are just going to remain very sensitive to some of this rhetoric right now. What we saw on Friday, I think, just shows how fragile sentiment could be right now. I don't think it's a bad thing, just because you don't want to enter an environment where it's people just blindly participating in the market and pushing things higher without warrant, right?
Yeah. Well, it just be careful. So with as heavy as we are weighted in technology in the S&P 500, 34% on a pure basis, that's a lot, right? Tech has run, right? So you do have to be careful, but you look at the other sectors, even communication services on an equal weighted basis, utilities, healthcare, staples, energy, they're cheap versus themselves, and they're cheap versus history. So there's a lot of opportunity. But on the seasonal comment, November to April is the strongest 6 months of the year. So yeah, October might be seasonally weak. We're heading into the strongest 6 month stretch of the year. So I think that's a reason to be bullish.
It's interesting too, because there is a lot of this market, a lot of the economy right now is tied to the AI build out. And, it really always boils down to, hey, are they going to achieve the growth estimates that the markets have priced in? If they are, then they're not overvalued. If there's some stumble, if we find that, the case for AI is, less positive or less sunny than we thought, then yeah, you'd expect the market pullback. Yeah, but they've achieved the revenue growth that's been necessary to justify the valuations up until this point.
Sure, bubble or no bubble in AI, don't the knock-on effects of AI trickle into the rest of the companies out there? I mean, every company is effectively using AI in some way, shape, or form, right? So you can argue, yes, there's a bubble in AI, but the other businesses are probably driving more profit to bottom lines. They're becoming more efficient. They're using technology in a way that's going to be a really strong knock-on effect and be good for the business. So,
that's where we have to prove out is it going to be worth the cost that they have to pay for the software, the licensing, all of that bundled in with AI. And I think that's where the rubber's going to meet the road eventually.
Yeah.
All right.
Well, I think, I guess just to close the loop on that, it's not like, I don't think an investor can afford to not participate in any of that AI
Correct.
thematic trade. At the same time, now is the perfect time to start rethinking position sizes, right? Take your victory lap. If you have outsized positions in highly risk-oriented assets, specifically some of those in the tech plus space, I'm not saying to blow out of them, but it just makes sense right now to start thinking about sizing appropriately and making sure you're comfortable with the risk you're taking. Now, along with that, there are plenty of opportunities that I would call undervalued in the market. There are other ways to diversify. We have gold that hit record highs as investors seem to be recalibrating macro-oriented risks. I mean, I think some of what has fueled the rally in gold and silver and other precious metals has been more or less just geopolitical uncertainty, safe haven demand on the back of that, but then also some inflation fears that have seemed to come back about over the last 2 months or so. Do you guys make anything of that? And do you make anything of gold relative to other kind of defensive assets?
I think gold is such a momentum asset class. It doesn't pay you anything. It works sometimes as a hedge, sometimes it doesn't work as a hedge. So, to me, gold's interesting, but at the end of the day, it is. I think it's very much kind of the beauty's in the eye of the beholder. People who like gold really like gold, and I think it just at this point is momentum. Similarly to the AI companies, gold is experiencing some really positive and strong momentum that's driving it forward.
Yeah, and I could argue on a technical basis it's overbought, and that doesn't necessarily mean that the trend can't continue, but I don't know if it necessarily has a place in a portfolio at these levels.
Yeah, well, I always struggle, and I'm happy to admit, just like any investor, I have my own biases that I always struggle with and all that. But like Matt said, gold is not an income-bearing asset. So you inherently, from day one, if you were to invest in gold, your opportunity cost is, let's call it roughly 4.5% that you're giving up if you wanted another defensive asset like a high-quality corporate bond, right? And I'm not saying that necessarily gold has just on an annual basis, a 4.5% hurdle rate that they have to overcome for it to be technically a good investment. But I do find these precious metals, these things that are essentially worth whatever anyone's willing to pay for them, it's just really hard for me to telegraph what something should be worth and when the right time is to invest in something, because that's the exact opposite of how I think about the market. I think about participating in compounding returns, and an income-bearing asset makes that really possible, whereas things like gold and other non-income-bearing assets don't.
Yeah, it makes it really tough to value at the end of the day. It's kind of like what do you think it's worth, and what are you willing to pay for it? And that's kind of the same thing. Who knows? I mean, you can make the argument maybe you're seeing some rotation into crypto. People who are really into crypto are rotating out into more of a hard asset, which is gold.
Sure. All right, let's close up with just some activity in the M&A space. I would say that we're starting to see merger and acquisition activity start to flare up again. Expected investment banking revenues, for example, for the third quarter of 2025 are expected to exceed $9.1 billion, and that would be the strongest showing since 2021. So fairly large resurgence, at least by anticipated metrics. The rebound right now is being driven by a fairly strong wave of leveraged buyouts, or LBOs, but also some IPO interest, and then just overall renewed confidence in deal making, which I think is partially coming from the expected downward trajectory of interest rates. So just to underscore all that momentum, one of the biggest recent consolidations that came about was Fifth Third Bancorp acquiring Comerica. Plan is for an all-stock deal valued at about $10.9 billion, and that's going to be among one of the largest regional bank mergers in recent memory. So I mean, this to me looks like a consistent trend. Banks seem to be capitalizing on lighter regulatory pressure out of the current political landscape, and then also just some favorable deal optics that have come to light under Trump in this administration.
And we as locals are now going to have to get used to calling Comerica Park Fifth Third Park.
It's going to be
which is unfortunate.
Quite the change.
Yeah.
Yeah. So I don't know. Like I said before, if I had to guess, I do think that the backdrop for deal making in general, as I look out over the next 6 to 12 months, it looks pretty favorable just with the general trajectory of interest rates should things pan out how we expect them to right now.
Yeah, I mean, and you're seeing that represented in the returns in financial stocks. Some of those largest banks, the Morgan Stanleys of the world, JP Morgans have done quite well. I mean, this has been a tailwind to their bottom line year to date so far.
Without a doubt. So just to recap quick, we talked through some of the recent ramifications from U.S. China trade tensions, what the rotation has looked like as a result. Also talked a little bit about some of the valuation concerns and our thoughts on valuation in the market in general. Also talked about potential for rotation throughout the market, as well as some seasonal trends, before we closed out with some discussion on hard assets like gold and then some caveats to the deal-making space. Anything else, guys, before we wrap up?
That's it.
Yeah, that's good here.
Okay, great. Well, thank you all for joining us for another episode of Blue Chip Now. We look forward to speaking with you next time.
All right.